অনলাইন ক্লাসরুম অব মহিলা কলেজ চট্টগ্রাম। আজকের অধ্যায় রিস্ক অ্যান্ড রিটার্ন। একটি ভিডিও দেখা যাক।
Understanding risk and return. Looking around us, we find that different financial products such as fixed deposits, bonds and shares give different returns. Why do the returns differ? To answer this, we must first understand the idea of risk. An important principle of investment is higher returns entail higher risks. Risk drives the returns on assets. Fixed deposits earn the lowest returns because they are considered the safest. Shares have the highest expected returns as they are the most risky. Investment-grade bonds have expected returns lower than shares because they are less risky than shares. In investing, there is no reward without risk. If an investment offers higher expected returns, it will generally have higher risk. Suppose investment A has an expected return of 3%. If investment A performs better than expected, actual return will be above 3%. If it performs worse than expected, actual return will be below 3%. Actual return will be 3% only if investment A performs as expected. The presence of risk or volatility means that the expected return can differ from its actual return. The difference between actual and expected returns is risk or volatility. A simple statistical measure for risk is standard deviation. The larger the standard deviation, the greater the overall risk of an investment. Compare investments A and B, which have the same expected return of 3%. As B has a lower standard deviation than A, it will give a higher return to volatility ratio known as the Sharpe ratio. In investing, we aim to maximize the Sharpe ratio, which maximizes return for the same risk or minimizes risk for the same return. Further, to be successful in investing, you must understand your risk appetite. Assess your risk appetite on 3 dimensions: needs, ability, and willingness to take risk. If you plan to retire by 40, you would need to generate higher returns that will allow for early retirement. If you have dependents, your ability to take risk is likely to be lower than someone with no dependents. If you have the need and ability to take on risk, but find it unsettling after buying a risky stock, then willingness is low. You may want to consider investments with a lower risk profile, such as investment-grade bonds. Imagine investing as choosing a roller coaster ride. If you choose a wilder ride than you can handle, you are likely to want to get off the ride halfway, as it is scary when it dives. Similarly, if you have investments that are too risky for your risk appetite, you may panic and quit them prematurely when the market dives. The key to successful investing is the ability to stay invested. If you get off the roller coaster halfway, you could lose your investments. By staying invested, you may also ride out market volatility and business cycles.